I, on behalf of the leadership and team of Grand Thornton, Uganda, want to extend warm welcome to all of you in this call. It has been more than 2 years since we met in person on our annual budget seminar, and we really miss that live interaction with all of you. And we all know that that is due to the pandemic. This pandemic of COVID has taken a lot of our loved ones and impacted economy, businesses, and families across the globe. It has also taught us a lot of new things which we would have otherwise have been neglecting, like our belief in God, give importance to health, discipline is something which is very important in our life, and also how to embrace the technology in our day-to-day life. And that is the reason why we have now organized this online budget webinar today, second year in a row. And we thank you all for your active participation in the same. With that remarks, I'd like to go back to the subject. As you are all aware that our advisory and tax team leaders decodes and analyzes the performance of various industry sectors, budget allocation for the next financial year, as well as amendments to the tax and other allied laws. And they'd like to present the same with impacts as analyzed by them. I would like to thank our teams who have worked day and night in last few days to prepare the presentation to present it to all of you. We hope that this analysis and the presentation will meet to your expectation. And once again, I want to thank all of you for joining this webinar. And we look forward to your active participation and also feedback at the end of the session for us to make improvements wherever it is required. With that, I would like to open this webinar. And Chelsea, you can please continue. Thank you.
Thank you very much, Mr. Shah. I'm sure everyone, as myself, appreciates the insightful words that you've given, the comforting words that you've given to all those who've lost their members. And we hope to God that this will end soon. So, as Mr. Shah said, we are going to start our webinar presentation. And a brief introduction is, we all know, like I stated earlier, the designated Minister of Planning, Mr. Amos Lugolobi, read the budget on 10th June. And the theme of the budget was industrialization for inclusive growth, employment, and wealth creation. So we are going to start with an analysis from the advisory department. They're going to take us through how the government intends in the next financial year to build the economy for the better of everyone, the low-income earners, the high-income earners. Each and every individual, more or less, has been covered to earn, as the government is trying to take care of everyone. They know that times have been hard. The pandemic has left many people jobless, many people sick, many people in sorrow because of their loved ones. So I am going to introduce the manager of the advisory team, Mrs. Himalsha. She is going to give us this analysis and explain to us better each and everything, as she is an expert in that department with over 15 years of experience covering various sectors of the economy, both locally and internationally. So I'm going to hand over to Himal. Please take over and give our viewers in this meeting the economic analysis.
Thank you, Chelsea. A very good morning to all our esteemed clients and attendees of this budget webinar. Let's look at economic review for financial year 2021 by studying key macroeconomic indicators, which show us how Ugandan economy performed during last year. The first and the most important macroeconomic factor to understand health of any economy is its gross domestic product. The present GDP of Uganda now stands at 148.2 trillion from 139.7 trillion in financial year 1920. So there is a tremendous increase in GDP, which is certainly a sign of healthy developing economy. Real GDP per capita has also seen an increase of up to USD 936 from USD 916 in the previous year. And USD 825 in the year 1819. The graph on the screen actually shows the historical GDP per capita of Uganda and the neighboring countries, Kenya, Tanzania, Rwanda. That of Kenya highlighted in gray color, which has seen a substantial growth. That of Uganda is in navy blue color. You can see that it has also been growing at a steady growth. At an overall level, despite the economic shocks orchestrated by COVID-19 pandemic, the Ugandan economy has registered a growth of 3.3% compared to 3% in the previous year. If we are to talk about sectors contributing to GDP growth, agriculture sector grew by 3.5%, which is by increase in cash crop, food crop, and livestock. Whereas industry grew by 3.4%, majorly by improvement in manufacturing activities, construction, and mining. And service sector has maintained a steady growth at 2.5%. The next macroeconomic indicator is inflation. Talking about inflation, the inflation generally remains subdued with the annual headline inflation at 2.6% and an average core inflation at 3.6% from July 2020 to April 2021. The target inflation by central government is 5%, and the headline inflation was well within that range. The State of Economy report of March 2021, however, indicates that the inflation is expected to peak at around 5.8% in the third quarter of 2021, before gradually reducing to or returning to its medium-term target of 5%. There are, however, risks to these forecasts due to various factors which could be related to weather-related shocks, lower than expected domestic demand, low sustainable global demand, etc., which makes the medium-term target of 5% a bit uncertain. Okay, coming to the balance of payment, we all know that balance of payment is the difference in the total value between the payments into the country and out of the country over a period. So balance of payments for Uganda can be highlighted through the current account deficit, which comes about when the import of goods and services exceeds the export going out of the country. The current account deficit increased by around 38% from USD 2.6 billion to USD 3.6 billion. In medium term, the current account deficit is likely to deteriorate further due to increasing trade deficit driven by improvements in domestic demand. The increased rollout of COVID-19 vaccine provides the opportunity for job market recovery, therefore an increase in remittances. On the financial side, FDI inflows are likely to remain moderate, reflecting the slow recovery of global private capital flows. However, this will be controlled by disbursements of project and budget support loans to finance government projects and COVID-19 mitigation expenditure. Bank of Uganda sets central bank rate, which is called CBR, every 2 months and uses repo and reverse repo, deposit auctions, as well as issuance of recapitalization securities in the secondary market to steer 7-day interbank money market rate towards the CBR. In April 2021, Bank of Uganda, the country's central bank, maintained CBR at 7%, having reduced it by cumulative 2% points in April 2020 and June 2020 when it stood at 9%. During financial year 2021, BOU also continued to provide liquidity support to the banking sector and maintained CRM measures it has initiated to start at the start of COVID-19 pandemic in light of enhancing the economic condition of the sector. BOU consequently took the actions in relation to sustaining provision of exceptional liquidity assistance through standing lending facility and extended CRM for 6 months effective April 2021 and have maintained COVID-19 liquidity assistance program to supervised financial institution. During the first quarter of financial year 2021, the commercial bank lending rate on shilling-denominated loans rose to weighted average of 20.22% from 18.62% in the previous quarter, predominantly due to continued risk aversion due to adverse effect of COVID-19 pandemic. However, the subsequent quarters registered a gradual decline in the lending rates in line with the accommodative monetary policy stance. In the 9 months from July 20 to March 2021, the weighted average interest rate on shilling denominated loans fell from 19.19% compared to 19.26% recorded in the same period. The weighted average interest on shilling time deposits also remained relatively stable to an average of 9.49% for financial year 2021 from 10.05% in the previous year. In the same period, the weighted average lending rate on foreign currency denominated loans averaged at 5.66%, which is down from 6.36% in the previous year. So let us now talk about the fiscal policy. Fiscal operations were affected by revenue shortfalls and slow execution of infrastructure projects. The domestic revenue was below target in the first 7 months. Relative to URA's target, the domestic revenue of net tax and non-tax revenues amounted to shillings 21.2 trillion, of which 1.6 trillion were non-tax revenue. The domestic tax revenue, indirect domestic tax, and international tax trade was underperformed by 465 billion, 374 billion, and 470 billion respectively. Moreover, the non-tax revenue also underperformed by 223 billion. Total government expenditure in the first 7 months amounted to 20.48 trillion, which was 3.35 trillion lower than the programmed expenditure, mainly due to the underperformance of 3 billion in the development sector. Total government expenditure grew by 15.4% as developments in government revenue and expenditure resulted in fiscal deficit of 8.5 trillion, which was lower than programmed deficit. However, the fiscal deficit grew by 34.3% during the period ending January 2020. The deficit was financed largely by domestic financing, which accounted for 60.4% of the total financing. The interest payments are projected at shillings 4.1 trillion, representing an increment of 53 billion against the projection at the start of the year. This increase was mainly due to high domestic interest costs and high domestic borrowing. So that was majorly an outlook on the macroeconomic factors of the economy, which can show us the health of the economy and the state of the economy. Coming to the budget, we are all aware that the theme for the budget for this year has been industrialization for inclusive growth, employment, and wealth creation. With the background to the budget with hashtag doing more, the budget is intended to focus on the economic recovery through increased production, enhancing supply, boosting aggregate demand and external market access. It is to support livelihoods through addressing poverty, vulnerability, regional inequalities, and sustaining job creation, as well as the other focus area is continued investment in growth enablers like infrastructure and skilling. In line with the Public Finance Management Act as amended, the budget was approved by Parliament on 7th May 2021. The overall budget has decreased by approximately 2% to shillings 44.78 trillion as compared to 45.5 trillion allocated in the previous year. This is further broken down into the targeted revenue increase by 16.2%, decrease in expenditure by 3.3%, and in turn projected fiscal deficit to reduce to 6.4% of GDP from 9.9% in the previous year. Coming to sector allocation, if we are to talk of agriculture, The budget allocated to agriculture for financial year 2021 has increased from shillings 1.3 trillion in the previous year to 1.67 trillion in year 21-22, which is an increase of approximately 28%, which also contributes to 3% of the total allocation of the budget. The government plans to focus on increased strategic investments in agriculture value chains for targeted products and development, as well as promotion of protocols for value addition in agriculture manufacturing and processing chain. Also, the other focus areas are increased capitalization of UDB and UDC, reviewing national food safety policy, and continued implementation of ACF, which is Agriculture Credit Facility by BOU, and Uganda Agriculture Insurance Scheme to support the private sector agriculture. The next sector is energy and mineral, where shillings 1.1 trillion has been allocated. This allocation is laid out into 3 energy-related development programs under NDP 3, which is for energy development program shillings 2.3 trillion, mineral development program shillings 59 billion, and petroleum resources program by shillings 57.8 billion, all totaling to 1.1 trillion. This 1.1 trillion allocation is a 57% decrease from what was allocated in the previous year. Some of the achievements of previous year are East African crude oil pipeline, paving way for construction of 1,435 km long pipeline to transport crude oil from Uganda in Hoima to the port of Tanga. Also increase access to electricity on 68,186 households added to the national grid, rising connections to a total of 1.62 million. These are just some, but there are many other achievements that were made in the previous year. So government plans to focus on energy and mineral in a focused manner by the points that were highlighted in the previous slide. Let's come to the work and transports. So for financial year 2021, the budget allocation to the sector is shilling 5.1 trillion, down point shillings 5.8 trillion allocated in the previous year, which is demonstrating 0.12% reduction. Out of the amount allocated to this sector, shillings 487.4 billion is towards the road maintenance, and shillings 135.9 billion is for road improvement. Coming to trade and industry, the budget allocation is 96.5 billion, which has also reduced from the previous year and is now contributing to 0.2% of the total allocation. The government plans to mobilize alternative financing sources for private investments, development of a transparent incentive framework that supports local investors, establishing national business development services framework, and also establishing centers for business registration and licensing in relation to trade and industry. The sector has basically remained relatively stable owing to the impact of COVID. Coming to also while we are talking on trade and industry, government is pursuing regionally balanced growth by having development of value chains, corridors developed between different districts, as highlighted in the map here. The other key sectors are security, where shilling 6.9 trillion has been allocated, which is contributing to 2.4% of the total budget. On human capital development, shilling 7.7 trillion. On tourism and hospitality, which has also shown a bit of a slowdown because of COVID, shillings 181 billion, and ICT at shillings 135 billion. So having looked at the macroeconomic factors and having looked at the allocation of the budget, it sets how the government intends and how the economy is expected to be operating over the next financial year. With that update, I would like to thank all of you for listening to me, and I would like to hand over to the tax team to take all of the viewers on the tax update.
New, and then we had a new system SAP. The credit notes became an issue for the old invoices.
Thank you very much, Ms. Himalsha, for that. Please kindly let me remind everyone, if you've just joined the meeting, if you've been on this meeting, please mute your microphone and please remove your video. Kindly, Amon, your video is still on. Kindly switch it off. Please, everyone who is on this call, mute your video, mute your microphone so that we can proceed without any background noise and avoid any other disturbances. So as we proceed, Hemal has given us, I think, a great insight into the economic analysis and what the government has planned for us in the next financial year. So we have learned, I think, numerous things in her presentation. The budget is over 44.78 trillion, and I'm guessing, just like everyone here, I'm also wondering, how is the government going to achieve that? We are from a pandemic, many people don't have jobs and all that, but I guess they have a plan for us. So we have to keep positive and pray. And as most of you are aware, the biggest way that the government funds the budget is from the domestic taxes. I think most of you are aware of that. So I guess they intend to collect more taxes from us this year. We look forward to that, and I pray that we all make it out after this financial year. But right now, I am going to introduce Mr. Ankit Jangla, our seasoned tax expert in the tax department of Grant Thornton. With over 10 years of experience in that department, he is going to guide us through the new tax amendments, the old ones that have been amended, the new additions, and how they are going to impact our different sectors, because many of you must be wondering, if they introduce this tax, how is it going to affect me? Am I going to get less money? Am I paying the government more money? Yes, he is going to take us through all that properly. He's going to explain each and everything for us so that we can understand. And Mr. Ankit, I can see that he's already on and he's ready. So over to you, Ankit. Please take our guest through how the government intends to collect this 44.78 billion, with 90% of money coming from taxes. Over to you, Ankit.
Thank you, team. Thank you, Chelsea. Good morning, everyone. Again, and thank you for joining this call. Like every year, we have been able to segregate the amendment into the different tax heads. And in that breath, let us start with Income Tax Act amendments. The very first amendment is to the definition section, which is section 2. In section 2, the definition of beneficial owner has been amended. Beneficial owner definition was first introduced by Income Tax Act of 2019. Now that definition has been tweaked. This has been done to bring this definition in line with OECD guidelines, to which Uganda is a signatory. Next is introduction of definition of consideration. Why? Why this introduction? The Income Tax Act in numerous places have been speaking or has been mentioning the word consideration, like in section 50, which brings capital gains into ambit of taxation, like in section 118, which brings the applicability of WHT on purchase of assets by resident from another resident. But the word consideration was never defined in the Act. To address this consideration, definition has been introduced. Point, point to note in this definition is consideration means any amount which is paid or payable and also includes the value of exchange of goods or services. Next, the definition of exempt organization has undergone a change. Previously, the words public character were mentioned in the definition, which were a subject matter of differential interpretations between various stakeholders. Now, that word has been repealed, and whose object is not for profit. The organization whose object is not for profit has been added to this definition. This shall help in faster processing of exemptions as the ambiguities surrounding the definition has been addressed. We move on to next amendment. The next amendment is to section 21. Section 21 covers the exemption side of income tax. So the very first thing which has been done is exemption on agro processing has been repealed. Now, though it has been repealed, but the same exemption has been already catered in section 21AF. So the exemption to agro processing remains, but it has now been tied up with certain conditions. Conditions in nature of investment criteria, raw material usage criteria, employment criteria to citizens or non-citizens, like that wise. Then a further amendment has also been done to widen the scope of strategic sectors over and above which were already in place. Some sectors which have been brought into the eligibility criteria for exemption on corp tax are glassware, electrical equipment, manufacture of chemicals for agricultural use, sanitary pads, diapers, so and so. This was section 21 amendment. Moving on to next amendment, amendment to section 22. Now, this amendment is quite significant. Why? Because it applies now to both individuals and non-individual taxpayers. How does it become applicable? Gross rental receipts, 75% of gross rental receipts should be allowed as expenditure. The way amendment reads, it seems that over and above this 75%, other deductions which are already factored in law, like interest expense, wear and tear, IBD, etc., would be allowable. Balance remaining after these adjustments or these deductions would be taxed at 30% equally for both individual and non-individual taxpayers. So the previous law, which had differential rates for individuals and non-individuals, have now been eliminated and a uniform rate has been brought on board. Next amendment is to amendment to section 27 and 29. This amendment caters or talks about the change in class of assets. Previously, till date, since 1997, there used to be 4 classes of assets, which has now been trimmed to 3. Primarily, computer and data handling equipment will fall at under 40%, plant and machinery under 30%, remaining everything shall go into 20%. Another significant thing which has been brought in this amendment is that while we have already proceeded to next screen, but the section 27 and 29 have further been amended to say that any qualifying asset, which means plant and machinery, which is placed in use outside 50 kilometers from Kampala, and industrial building on which the initial allowances are claimed or eligible to be claimed. So in the year 1, when an initial allowance is claimed, in that year, no depreciation would be available or no wear and tear would be available, but it will have to be deferred to year 2. So it's that one, that's a significant part of this amendment which needs to be noted. We move on to Section 50. Section 50 is the amendment which was paid or represented by Grant Thornton at various forums through Ministry of Finance, our managing partner through PIRT. Now, what is this amendment? This amendment is adjusting the cost base of an asset at the time of computing capital gains by the inflation factor. To ease the concept of Section 50, we have tried to demonstrate it with a simple example. Say a warehouse is sold in December 2021 for $5,000, which was acquired at $2,000. So as of now, how the law stands, $3,000 would be considered for purpose of capital gains. Going forward from 1st July 2021, this is going to change. So first of all, this $2,000 would be adjusted by consumer price index of the month of sales and of the month of purchase, and a revised cost base would be derived, which is in this scenario $3,000. So if $3,000 is liable for tax, $1,000. Sorry guys, sorry members, my apology. Maybe because of network issues, I was not audible over here. Let me repeat myself for Section 50 again. What is Section 50? Section 50 is adjusting cost base of an asset for purpose of capital gains by an inflation factor. This amendment was represented or lobbied by Grant Thornton through various channels at Ministry of Finance or by our manager. So in the interest of bandwidth, sorry to interrupt, in the interest of bandwidth, I have switched off my video. Again, coming back to Section 50, apologies, but again, coming back to Section 50, what is Section 50? Section 50 is adjusting the cost base of an asset while computing capital gains tax with the inflation factor or the CPI, what is famously known as Consumer Price Index. So this amendment was always lobbied or represented by Grant Thornton at various forums at Ministry of Finance or by our managing partner at PIRT. Now, how this amendment works, we have tried to demonstrate it through a simple example. Say a warehouse is sold in December 2021 for $5,000, which was acquired in 2015 for $2,000. The gain as on today will be $3,000 and tax would have to be paid on $3,000. But now this is going to change beginning 1st July 2021. So the cost of acquisition of $2,000, as you can see over here, is adjusted with the CPI of the month of sale and month of purchase, and it has been inflated to $3,000. This $3,000, if subtracted from 5,000, the gain liable for tax will be $2,000. So this is how the benefit in tax savings will come to a taxpayer through this amendment. Moving further to an amendment in Section 54, a registered venture capital fund, if invests more than 50% of the proceeds into another business or another fund, will get an exemption from capital gains on entire gain which has been made. And if the proceeds are reinvested which are below 50%, then a proportionate capital gain exemption would be granted equivalent to the investment being made. Next, Section 88. Section 88 can also be linked to the definition of beneficial owner. But what is Section 88? Section 88 speaks about international agreements with Uganda has been a treaty to. So with this section, the commissioner is empowered to exchange the information with DTA countries, which means double tax avoidance treaty countries, because Uganda is a member of OECD and also has subscribed to automatic exchange of information rules beginning 2023. Through this amendment, it paves the way for minister to make the guidelines or regulations on the modalities to exchange the information with overseas tax authorities. Amendment to Section 93A. Currently, there has been some discrepancy or there has been some confusion on the date from which the interest needs to be computed in case of delay payments. This has now been clarified or addressed. So the current amendment, as per the current amendment, let's say the financial year of a taxpayer ends in December 2021. So any unpaid tax or principal tax will be considered for interest calculations from 1st July 2022, which means the due date for filing of computation of interest has now been synced. Further, if assessment from Uganda Revenue Authority through a commissioner, so the liability mentioned investments, if agreed to, are to be paid within 45 days. Next, Section 113 talks about refunds. Now, refunds by their very nature has sometimes been subjected to delays attributable to both taxpayers and tax authorities. And always the questions used to come that what happens to the interest on delay receipt of refunds. Now that has been clarified. How? The delay payment interest will be computed from the date of submission of additional information, from the date when additional information as requested by URA is submitted. Another thing, which is a step in very positive direction, the refund process has now been made time bound. How? The refund process has been mandated to be completed in 6 months duration. So this will help in faster or efficient processing of refunds. Amendment to first schedule listed institutions, Africa Export Import Bank and International Union of Conservation of Nature has been added to this schedule. They will qualify for automatic income tax exemption without being applied to commissioner. Some of the proposals which were not able to pass through or which were not made into law or were passed with some modifications was separately taxing of income from each property, then giving blanket exemption to manufacturers in any industry whose investment capital is USD 50 million, then taxing of rental income for individuals and non-individuals. In the proposed bills, the expense cap was made at 60%, but now it has been enhanced to 75%. Further, the exemption, WHT exemption, which is given to a taxpayer, can be utilized in the transactions of business or business assets as proposed in the bill, but now because it has not been passed into law, the status quo remains. Moving on to the next eight, this takes care of income tax amendments. We move on to value-added tax. The very first amendment to the definition sections. Now, biodegradable packing materials. The definition of biodegradable packing materials has been struck off or eliminated. Why? The logic behind it is simple. By the Act of 2012, the exemption given to from VAT on supply of biodegradable materials was also repealed. So this definition was not making much of sense, or it was not really necessary, and therefore policymakers have struck off this definition. Going further, we come to Section 20. allow me to 1 minute. Yeah, now the screen is visible. Yes, section 20. Now, what is section 20? Section 20 talks of which kind of importations are exempt from VAT in terms of goods and services. So, the importation on service was catered by section 20A. Now, through this amendment, this 20A has been repealed or struck off, and the exempt imported services are also clubbed with section 20, leaving the overall impact unchanged. But the one worthy amendment to note over here is any service which has been imported to supply an exempt service will also be out of VAT. The exempt services, like you can see in your slide, are financial, medical, some kind of insurances, etc., etc. So this is a significant part of this amendment. We move on to the next bit of the amendments. Amendments to section 28. What is section 28? Section 28 allows or provides a mechanism to claim input tax credit. This input tax credit, as of now, currently stands, is allowed on any kind of invoices. Means an invoices may be of a one which have elapsed 12 months or which have elapsed 24 months would be entitled for input tax credit. But with this provision, this has been restricted. What happens now? The window to claim input tax credit from the date of invoice has been now been restricted to 6 months. This has been brought in synchronicity with IFRS system, the system which is quite buoyant, and it will help to properly implement this section. Also, it will avoid the deferred input VAT claims which were going on for years and years. So it's like cleaning the books, exercise to clean the books. But the cap of 6 months must be very, very much noted. Going further, we go to section 31A. Section 31A, by section 31A, there are certain taxpayers who, if provides the services which are mentioned in section 16, like radio or television broadcasting services, electronic services, can file their VAT returns quarterly. So a taxpayer providing services in any of the services which are mentioned in section 16 can file their returns quarterly. This there is some kind of a gray area in this amendment as to who does it apply to. Does it apply to non-resident service providers? Does it apply both to non-resident and resident service providers? Does it only apply when the service recipient is a taxable or a non-taxable person in Uganda? But as we evolve and as we settle down, we shall be able to guide you on accurate guidance in terms of section 31. We go on to section 45. Section 45 is a step in very positive direction. It's a step to widen the tax base. And how? Through this amendment, the government is encouraging people or other non-taxable persons to buy from an organized players or the registered dealers. So if any non-taxable person in VAT will buy goods worth shillings 5 millions in period of any consecutive 30 days, the buyer would be eligible for refund of 5% of the tax paid or the VAT tax paid, which means it will obviously encourage the buyers or non-registered taxpayers to register and come into the tax base, and also an unorganized players to register themselves so that they can capture or they can go into this or they can get hold of this market. Yeah, and the people would definitely be asking for tax invoice every time now. So a very positive step and step worthy to note. Moving on, we go to section 55. Sorry, take your pardon. Section 65. Section 65, the words knowingly or recklessly have been struck off or repealed to make the enforcement of law wherever there are wrong statements made or misdeclarations being made more critical, and the person who is making those false declarations or misstatements is liable to a penal tax which is double, which can be double the amount of tax in the question. Going further, uh, amendment parallelly linked to amendment in first schedule in Income Tax Act, Africa Export-Import Bank and International Union of Conservation of Nature has now been brought into first schedule of VAT, which means these entities will qualify for VAT benefits and VAT refunds as specified in section 45 of VAT Act. Second schedule to VAT. What is second schedule? Second schedule speaks on exempt supplies. The supplies which are exempt from VAT when made in Uganda. Now there has been some change to this schedule. How? We have tried to summarize it. Incentives to the hotel or tourism facility exposure, tourism facility developers, when they make certain purchases, have been withdrawn. The supply of production inputs into limestone mining and clinker in Uganda has been withdrawn. New category of service lines or supplies are being added. They are supply of denatured fuel ethanol from cassava and also supply of liquefied gas, although it was already there in 2020, but it has further been uh, emphasized or further, it has been now also added for in the list of exempt category. Further, and manufacturer who has investment capital of USD 30 million in case of a foreigner and USD 5 million in case of a local investor would get exemption on purchase of certain inputs in form of feasibility study or design or construction. Moving on to amendment in third schedule. Third schedule are the zero rated supplies. Now, in order to boost the aviation sector, predominantly Uganda Airlines, the supply of lease aircraft engines was already under zero rated supplies, but now even the repair services for these aircrafts have also been bought into zero rated supplies in order to boost the sector. This takes care of the amendments in VAT Act, while as in income tax, we have also tried to summarize some of the proposals which have not been passed into law or passed with some modifications. The proposal to consider the non-taxable person for purpose of VAT refund. Previously, it was 10 million shillings for period of consecutive 30 days. Purchases were 10 million shillings, but now they have been made at UGX 5 million. Then repealing it was intended to repeal the exemption provided to the taxpayers in business of iron ore melting into billets and all, which has not passed through and it still remains. And certain exemptions which were being intended to provide to manufacturers with investment capital of 50 million have now been made to 30 million for foreign investor and 5 million for a local investor. Now, with this two slides or with these two amendments, we have taken care of income tax and VAT. As we move on to the next tax head or the next act, which is Excise Duty Act, there have been some amendments in Excise Duty Act since it was introduced from 2014. Now, the first amendment is the registration requirements. Currently, the registration requirements need renewal in every 12-month period after every 12-month period. This has now been scrapped, or once registered, there is no longer a requirement to renewal. Then plastic products which are used for purpose of export or packaging medicaments, or plastic products which are manufactured from recycled plastics, and excise duty paid on these products will be available for remission, means refund. This is a similar kind of an arrangement which is ongoing or which is catered for in East African Community Customs Management Act, but it is a point to note for because it is going to promote the exports and obviously the pharmaceutical sector. Then there are a list of items in second schedule which have undergone the change in duty rates. It maybe the duty has been uplifted, sometimes duty has been completely eliminated on a particular item, or sometimes the duties have been reduced. The crucial amendment to note over here is aligning the excise duty on airtime, data provision, and value-added services in telecommunication sector. Then bringing into net the plastic products and plastic granules into the net ambit of excise duty, and also making excise due and also inserting new items like fermented beverages into the ambit of excise duty. Further, uh, the manufacturer who has an investment capital of 50 million also can get the waiver on excise duty or for purchase of construction materials. Again, in excise duty, some of the amendments which were not passed into law. Wheat was proposed to be brought into the ambit of excise. This has now been not passed. Now we now, in order to see, we have been, or I have been mentioning the exemption to a business or a manufacturer with investment capital of this in income tax, then in VAT, then in excise, then in stamp duty. In order to ease the understanding of the attendees over here, what we have tried to do is that, look, there is a disparity in these exemptions. As till today, what we have seen is there was always a synchronicity, means an exemption if provided under an income tax for a particular industry was always catered in other following acts like VAT, stamp duty, excise. But this time it has not been made so, especially for a manufacturers whose investment capital has been fixed at certain criteria, like for income tax, no such exemption is granted to a manufacturer with certain capital limit. Exemption is only for strategic sectors in income tax. Then in VAT, exemption is granted, but the investment capital limit is 30 million or 5 million, as the case may be. Excise, the cap is made at 50 million, and even in stamp duty, it is 50 million. So the purpose is to bring out this disparity, which we all have to deal with, because law is law, and policymakers have definitely thought of it. This has taken care of the tax amendments, but obviously we want to go to now procedural aspects of how this tax amendments or how the tax statutes would be enforced or implemented through the amendments in Tax Procedures Code Act. So the very first amendment in Tax Procedures Code Act, if we want to summarize this amendment to Section 3, it is simple. If a taxpayer has opted for a private ruling, or a taxpayer has opted for a voluntary disclosure, means a compounding of an offense, and if he is aggrieved by that decision of URA or the commissioner of URA, then there is no option but only to go to a further forum. It cannot be objected to because it has been kept out of the definition of a decision. Next, TIN identification number. Yes, like already mentioned, the government is in that direction to expand the tax base and also to stricten the enforcement as when it comes to TIN numbers. So in that breath, what the new law says that any local body or other authority will not be able to give license to the businesses if they don't possess TIN numbers. Also, another thing which has been added is that those businesses or those investors or those taxpayers who are also registered in foreign jurisdictions with which Uganda has DTAA needs to share their TIN numbers with the authority over here in Uganda. Next is amendment to registration of tax agent. This amendment applies more specifically to us as a Grant Thornton or people like Grant Thornton who are consultants or who are professionals giving those services. So uh, the registration as a tax agent has been made mandatory. Any person or any non-individual cannot provide services like filing of tax returns, representing taxpayer to URA, if or applying for private ruling if that individual or a body is not registered as a tax agent with Uganda Revenue Authority. Another change. Previously, advocates were not required or were not mandated to have tax agent registration. But now, yes, for certain services, they are not mandated to have. But if they want to provide services in relation to filing of tax returns, some certifications, then even they need to compulsorily enroll themselves as tax agents. Going forward, some house cleaning exercise in section 14. Section 14 talks about the liabilities and obligations of tax representatives. Means a representative for a taxpayer. Now this section had some drafting errors as instead of tax representatives, what tax agents was mentioned. So especially in subsection 2 and subsection 5. But now these words have been struck off and they have been replaced with word representative, making giving a proper message or proper guidance which it intended to give. Penal taxes in relation to tax stamps, anybody selling stamps without goods or affixing stamps on goods which are not mandated to be passed through tax stamps are liable for penal taxes, including the imprisonment. Then amendment to section 23. This is a very crucial amendment. Why? Currently, how law stands, any taxpayer can amend their returns after filing the return for a period of 12 months. So now this is supposed to change from 1st July. How? That window has now been expanded to a period of 36 months. So a taxpayer by himself or by herself recognizing any errors or any items which have escaped their attention and wants to amend their returns, they have window of 36 months available. This is also a very good step and a step to voluntarily clean the books or records at URA and gives the taxpayer a good opportunity to do that. Further, objection to a tax decision. Now, currently, an any taxpayer who is aggrieved by a tax decision or an objection decision has to go to tax appeals tribunal. Now, in order to reduce this burden or to reduce the piling of cases at TAT, the alternative arrangement has been provided. What? A dispute resolution procedure will be introduced, an alternative dispute resolution procedure would be introduced, and any taxpayer aggrieved by tax decision would be able to counter appeal at this forum, and the provisions on how this law or the sections will work would be uh, would be properly elaborated through regulations which Minister of Finance would be coming with in the future. Now, this is a significant amendment, and this can be called as elephant in the room. Why? Because Section 38 speaks about allocation rules. Now this has been changed. So the earliest liability rule is now repealed, and any tax payments will be allocated in the order of principal tax, penal tax, and interest tax and interest. So, which means the unnecessary accumulation of interest which was happening into the ledger accounts would now be stopped if this law is implemented in a right spirit. We go on to the next amendment. Next amendments are amendments to the penal taxes or offences, the amount of that penalties which are prescribed for particular offence. They have gone through a change, and while we may not be able to go through all of them, but they are quite elaborative in themselves. So those have been changed in between section 54 to section 63. As you can see over here. Now, some of the proposed amendments which did not pass into law is the power modification of powers which were supposed to be given to commissioner during the investigation. Those powers have not been modified, and status quo remains. Now, allied laws. What are allied laws? Means the laws other than Income Tax Act, excise duty, which have also undergone change in this year budget from next fiscal year. So the Stamp Duty Act, which obviously was covered during the time of showing the disparity between the exemptions between the various statutes, have now been amended to incorporate to incorporate the amendment saying that a manufacturer who has investment capital of 50 million will get waiver or exemption from stamp duties while making the share capital increase or transferring the land or registration of land lease, etc. Mining Act, levy on processed gold has come, an export levy on processed gold of 5% of the value of a kilogram of the gold which is exported out of Uganda, and this has to be paid by exporter. Again, levy on unprocessed minerals at the rate of 10% of value of the unprocessed minerals which are exported out of Uganda. Tax Appeals Tribunal Act has also been amended to incorporate a new court or a new channel of judiciary. Why? In case if anybody is aggrieved from the decision of High Court, has to appeal that decision to the Court of Appeal, and from Court of Appeal to Supreme Court. Further timelines have been mentioned for the decisions to be made by this honorable courts. So these were the amendments in Tax Appeals Tribunal Act. Fish Act has been amended to introduce an export levy of 7% on the value of fish more which is exported. So these were the high level amendments in terms of other allied laws. And this is how we have now been able to take care of all the amendments made under all the tax statutes which would be applicable from July 2021. We thank you again for listening to us patiently as I hand over the proceedings to my colleague Chelsea. Thank you.
Thank you very much, Ankit. I'm sure everyone here appreciates the time you've taken to take us through the new tax amendments that have been made. And I'm sure they also have very many questions, as I do. I have so many questions. I'm seeing new things like where excise duty on data that we're going to buy. I'm seeing things when it comes to rental tax have also changed. So I am sure everyone has many questions. I'm seeing some questions coming in through the chat box. Some have been answered by Mr. Jasmine Shah, and others are still lacking more clarification. For those which have been answered by Mr. Jasmine, I am just in case the individuals who asked have missed them, I'm just going to read them out. Mr. Rakesh asked a question that whether we have to provide supporting documents to claim 75% deduction from rental income. Keep this proper, I think, pause that for clarification. Mr. Jasmine managed to answer that question, and he was like, though the suggestions by the committee to the parliament was to cap the allowable deduction to 75%, as per the current interpretation of the amendment, no supporting documentation will be required to claim 75%. We may have to wait for final gazetted acts if there are any changes. So I hope that was a satisfactory answer for Mr. Rakesh. And he can scroll back into the chat if he wants to read further or post another question if he wants to understand better. Mr. Regan asked a question, will rental taxpayers who are in a loss position in one property be able to net the loss off in any other taxable rental income of any other property with this new amendment? That was also answered by Mr. Jasmine. Yes, the proposal related to payment of taxes for each property did not go through, and hence it will be possible to offset losses of one property against another property. He also answered one last question that was going to Mr. Viren. He asked, for depreciation as it is applicable from 1st July 2021, the company having financial year January to December than for first 6 months old. I think he wanted to ask when this new amendment in the wear and tear schedule would be applicable for his company if it's having a financial year from January to December. That was also answered. If the financial period end of the company is January to December, the amendment would be applicable from the next financial year of your company. Mr. Viren, I am hoping that you ask this question in regards to your company and everything. So for the other questions that have been asked in our chat box, I have seen many questions asking for proper clarification on indexation, which has been added to the Income Tax Act. So I am going to ask our tax experts to please further elaborate on how that is going to work and how it is going to profit or help the different individuals affected by it.
Yes, thank. Okay.
Hi, Chelsea, thank you so much for this one. The indexation basically will give the benefit of the inflation during the period the taxpayer has holded the property. This is a very simple understanding of the indexation and the inflation concept. So what will happen if you have bought the property before 5 years and then you are selling it now? Obviously, due to inflation, the cost of living has gone up, and up to now, there was no benefit for the property holder to get that as a cost or the inflation benefit that has to be added to the cost. What will happen now, as probably explained in the presentation itself, that the cost of the property will be increased by the inflation during the period when the property was holded. So as your cost will go up, your taxable income or the capital gain tax will go down, and your tax liability will go down. So this is the crux of the the amendment. This is available in India and in many other countries as of now, this kind of arrangement. However, in Uganda, it was not introduced up to now. But as our presenter Ankit explained, due to the lobbying of the tax consultants like us, now government has finally introduced this. So it will be helpful for the people who are dealing in properties.
Thank you very much, Rikin, for that explanation. I hope that it has, those who are asking the question, I saw numerous questions coming in about it, you have understood. And in case you haven't, please feel free to reach out to us on our email addresses, on our website. We shall get back to you within 72 hours. You will get a response. At the moment, we are in COVID time, so social distancing, online everything. Visiting the premises is not highly favorable with the pandemic and everything, but you can send an email, you can give a call, and we shall explain that issue better. So I am also seeing numerous other questions with regards to the changes that have been made to the tax on rental income. I am also going to ask our experts to please broaden the explanation for our listeners and help them understand how this new change is going, especially those who are in the rental business, whether for commercial or residential, how it is going to work and how it's going to benefit them or how it's going to affect them. I am going to ask our experts to also help us with that.
Thank you, Chelsea. Want to answer one query from Mr. Prakasan. It's about applicability of VAT on imported services. Yes, Mr. Prakasan, that exemption would be available to a taxpayer who has both exempted and standard rated sales. Obviously, it will have to be properly apportioned, and the documents or the workings would only be able to give you proper guidance on what percentage it will be applicable on. I hope I was able to address your concern. Thank you.
Thank you very much, Ankit. We welcome more questions. We still have about 5 minutes left for the question and answer session of this meeting. So please feel free to type your question in the chat box and let our experts get to you and answer you in due time. So anyone with a question, we still have about 5 minutes. About anything that you need further guidance on that hasn't been answered, anything new, please feel free to send us your question so that we can answer you. Okay, I don't see any new questions coming in. And don't you people want to know anything else, the new amendments, how they're going to affect your business, how I'm sure many of you are now cooking up ways to dodge them. Come on, ask us some questions, interact with us, let us give you our opinion, let us help you understand better how these new changes are going to affect your business in a positive or in a negative manner. Okay, I see a question from Rash. Hold on. Okay. So seeing that the questions are not coming in at the moment, I'm guessing everyone is at the moment satisfied. But in case you come up with any more questions in the future, please feel free, like I stated earlier, to reach us on our email addresses and the phone numbers. They will be available and they will be shared with you. And we shall be able to answer any questions that you have. I want to thank our speakers, Ankit and Himal, for the insight. Thank you very much. I appreciate on behalf of everyone. I'm sure we have learned more, and in the next financial year, we are going to prepare better as it starts. We are going to be more prepared. We are going to be head on. So at this moment, I would like to conclude our meeting. But before I conclude this meeting, I want to have some closing remarks from our dear esteemed managing partner, Mr. Anil Patel. He has been in this industry of audit, tax, and advisory for over 21 years. He has worked tirelessly to build so many of us in that area. He's been a mentor, he's been a teacher, he's been a shoulder to cry on sometimes. He has, I'm sure everyone in the Grand Thornton family and outside there appreciates his work and a lot. So I am going to pass on the presentation to him so he can give us some concluding remarks before we close his webinar.
Thank you very much, Chelsea. Thank you so much. Let me first of all thank all our participants in great number to attend our today's budget event. It isn't easy to be on the call for almost 1.5 hours, particularly on Monday. That's the first day of the week. It's very busy for all of us. We have a lot of tasks to deal with, urgent and important, but still you give your time to attend to this particular event, knowing the fact that there is always a unique analysis, much more insightful by our experts when it comes to the budget. And thank you for recognizing that. This shows your interest on the subject and hunger for the compliance. We are delighted to know that your trust and confidence in our analysis over the years have increased. We thank you for that. I'm sure you would have got a better understanding of the state of the economy after listening to the presentation from Hamal, and also the effect of the amendments in the tax laws, and also its impact on your respective businesses. You would have got a lot of clarity. I saw you have asked the questions. We anticipated those questions. But as you know, there is hardly a direct yes or no answer to any tax question. Tax is something always, there is ifs and there is buts, and therefore you need a lot of clarity, sometimes second opinion, but we have always been very critical and very careful when we give our answers to those questions. I'm sure you would have known from the experience so far that you have with us. If there is still a question, as our MC has said, feel free to write in the chat box now, or also you can send us an email. We shall also be sending you this presentation as well as a detailed analysis of every section, every provision of the law that has amended. We will send you that detailed analysis with our comments and probable impact in your businesses to you in a day or two. So you will have a lot of understanding from there as well. So finally, we all need to be very careful when it comes to this deadly virus. We know it. There is always that fear in our mind in whichever position we work. So let's be very careful. I'm sure we must have taken a vaccination for us and our family and friends. If not, please do consider that as well as soon as possible. At the same time, we need to carefully manage our business in this pandemic. We know that except a few industries, most of our businesses are really affected. We know that competition is already there, economy is not doing well, but at the same time, performance of business needs more resilient by adopting a unique approach to our business. Who knows that is yourselves. But if you need any further support in that, in any explanation, any support in making your business more resilient, feel free to contact us. We have advisory team who will be able to assist you. I also wish to share my recent experience working with Uganda Revenue Authority, particularly after the new management. As you know, the Commissioner General has changed. So like all our businesses, UR is also under pressure to collect more taxes to support the budget. And that's a reality. We all know that URA should not only rely on those who comply, but also bring those who never comply on board. And that has been our complaint. It's very, very genuine. We do represent that to top management of Uganda Revenue Authority through various other organizations where I represent, or where we represent rather. And I'm sure that there is an effect in every budget. URA is doing a lot, but at the same time, the reliance on those who comply is also greatly increasing. You must have seen those big ledger account related outstanding. You must have also experienced rejections of your withholding tax exemption applications with those particular criteria that you would not have met. I know you are going to do a lot, but should you need any assistance, we are equipped and we are available for that. But it is also a fact that there is a call for all of us to comply. Compliance is unavoidable. I know whether we like it or not, although you do it, because the client base that we have and people whom I know, most of you do so. But should you still need any assistance, any further query or question that you have, any confusion that you have, sometimes you have questions about your competitors, how do they do, and why isn't that is applicable to them. But let me assure you that the law is applicable to you and your competitors all. It's a matter of time. So rest assured, compliance is always better. On that message, I once again thank you all for your active participations in this presentation of ours, and wish you a lovely afternoon. Let me now ask Chelsea to take over from here on. I thank you once again. Thank you.
Thank you very much, Mr. Neil. We appreciate those words and we're going to take them with good heart. Again, I would like to thank our speakers for the day, Mr. Ankit, Mr. Rikin, Mrs. Himal. Thank you very much. Our partners who have made this happen, who have organized this webinar for us, Mr. Neil and Mr. Jasmine, we greatly appreciate you, and I'm sure our guests also feel the same way. As we come to the close of this meeting, please don't forget to keep safe. Times are hard. Maintain a social distance, wear your mask, stay at home if possible. And for those who are sick, we encourage you to please keep taking your medication, stay positive, and wait for the end of all this. Everyone at home, please keep a positive mind, make your body active at home. If your soul is active, your mind is active, your body is also active. So when all this ends, we would like to be able to all sit in a room again without a mask. And we would all like to share a hug again. I'm sure there are so many of you who haven't hugged people in a while, but I personally would like to get a hug when all this is done. And I would like to sit in a room with people and laugh and see their smiles and hear them talk without putting on a mask. Thank you very much all for your time. I pray that you have a fruitful week, and bless you all for giving us your time and attending the Grant Thornton webinar. Have a lovely week.
Bye, everyone. Thank you all.
Thank you very much.
Thanks a lot. Bye-bye.
Thank you.
Thanks to Team Grant Thornton, especially Anil Bhai, Jasmine Bhai, Nilesh Bhai, everyone for this good session. Thanks a lot.
Thank you very much.